August 1st, 2012, 9:30 a.m. In the next 45 minutes, Knight Capital Group will lose $440 million. The cause is not a hack, not a rogue trader, not market manipulation. The culprit? 8 lines of dead code, left on production servers for nearly a decade. By 10:15 a.m., Knight will have accumulated $6.65 billion in unwanted positions. This wasn't just a software bug. It was one of the most catastrophic control failures in modern market history. October 16, 2013, the Securities and Exchange Commission issues order number 70694. Respondent, Knight Capital Americas, a New Jersey-based broker-dealer. In 2012, Knight represented approximately 10% of all trading in listed U.S. equities. The order details violations of Exchange Act Rule 15C3-5, the Market Access Rule. This rule requires brokers with market access to maintain controls reasonably designed to manage financial and regulatory risks. Knight's nerve center was SMARS, an automated high-speed order routing system designed to receive parent orders and divide them into child orders for market execution. In July 2012, Knight modified SMARS to participate in a new NYSE retail liquidity program. July 27th, Knight begins deploying the new RLP code. SMARS ran on 8 servers. The deployment happened in stages, 1 server per day. The new code was designed to replace old, unused functionality. That functionality was called PowerPeg. The PowerPeg logic was not newly written. It was legacy code, partially disabled years earlier, but never fully removed from the production environment. In high-speed trading systems, removal introduces operational risk. Refactoring introduces latency. Rather than redesign the protocol architecture, dormant logic remained embedded inside live infrastructure. It was faster, it was cheaper, and it was never revalidated under the new configuration. PowerPeg's original purpose: send child orders incrementally until a parent order was filled. It relied on a cumulative quantity function. This function tracked how many shares had been executed. When the parent order was complete, PowerPeg stopped sending child orders. In 2003, Knight stopped using PowerPeg. In 2005, Knight moved the cumulative quantity function to an earlier point in the code sequence. They did not retest PowerPeg after this change. They did not remove PowerPeg from the servers. The new RLP code repurposed a flag that previously activated PowerPeg. When set to yes, the flag was now supposed to engage RLP functionality, not PowerPeg. Between July 27th and July 31st, the new code was deployed to 7 of the 8 servers. 1 technician handled the deployment. No second technician reviewed the work. Knight had no written procedure requiring such a review. On 1 server, the deployment failed. The technician did not copy the new code to that server. The old PowerPeg code remained active. No one noticed. August 1st, 8:01 a.m. Pre-market trading begins. Knight's internal systems generated 97 automated warning messages. These were known as bayonet rejects. The earliest occurred nearly 90 minutes before the market opened. These alerts were the definitive warning. The yes flag was attempting to wake up the dead PowerPeg code instead of executing the RLP. 9:30 a.m. The market opens. Knight receives 212 parent orders from broker-dealers. These orders are flagged for the retail liquidity program. 7 of Knight's 8 SMARS servers had received the new retail liquidity program code. 1 had not. That final server continued to execute legacy PowerPeg logic. PowerPeg begins sending child orders, but the cumulative quantity function is no longer present in PowerPeg. PowerPeg does not know when to stop. For each parent order, PowerPeg sends child order after child order, in rapid sequence, without regard to whether the parent order has been filled. One part of Knight's system recognizes that parent orders are complete, but this information is not communicated to SMARS. SMARS continues to send orders. The 8th server floods the market. Knight receives executions, millions of them. 4 million executions, 397 million shares, 154 different stocks. The data existed, but the control framework required human interpretation. No automated pre-trade control prevented order entry. The system was built for speed. It was not engineered for autonomous containment. Knight's technology team attempts to diagnose the problem while the system remains live. SMARS is still connected to the exchanges, still routing orders. At approximately 9:58 a.m., Knight personnel identify that SMARS is malfunctioning. They attempt a fix. They uninstall the new RLP code from the 7 servers where it had been deployed correctly. This makes the problem worse. Now all 8 servers are running the defective PowerPeg code. Additional parent orders activate PowerPeg on the 7 previously functioning servers. The flood intensifies. At 10:15 a.m., 45 minutes after the market open, Knight stops SMARS. By this point, Knight has accumulated approximately $3.5 billion in net long positions across 80 stocks, and approximately $3.15 billion in net short positions across 74 stocks. Total exposure, $6.65 billion. In 75 of the affected stocks, Knight's executions represented more than 20% of trading volume. Share prices moved by more than 5%. In 37 stocks, Knight's executions represented more than 50% of volume. Prices moved by more than 10%. Other market participants were affected. Some received less favorable prices. Others received more favorable prices. Knight now holds billions of dollars in positions it never intended to take. The positions must be unwound. Knight does not have the capital to hold them. By the close of trading, Knight faces a net capital deficiency. It violates capital requirements. The loss is realized over the following hours as Knight liquidates the positions. Total loss, more than $460 million. Knight Capital Group's pre-tax income for all of 2011 was $115 million. This single event erased 4 years of profit. The SEC identified systemic control failures. Knight lacked pre-trade controls to block erroneous orders before market submission. No output monitoring, no order comparison mechanism, no automatic halt for abnormal activity. Capital limits were not linked to order entry. Post-execution monitoring system could observe exposure, but could not stop it. Risk management documentation was incomplete and outdated. Key systems were omitted. Procedures were finalized nearly a year after the compliance deadline. There were no written code deployment procedures, no dual review requirement, no testing protocol for Dormant production code. The CEO certified the existence of processes, but not actual compliance with the rule. Knight settled without admitting or denying findings. Civil penalty, $12 million. The firm also violated Regulation SHO. Erroneous short sales were not properly marked. Required locates were not obtained. In 2012, Knight was acquired by GetCo. The firm ceased to exist as an independent entity. The failure occurred just 1 year after the market access rule took effect, a rule designed to prevent precisely this type of breakdown. On October 16, 2013, the SEC noted in its order, a written procedure requiring a simple double check of the deployment of the RLP code could have identified that a server had been missed and averted the events of August 1st. The failure was not a single coding error. It was an architecture optimized for speed, but insufficiently engineered for containment. In modern markets, execution is automated. Oversight must be engineered to operate at the same velocity. On August 1st, 2012, the systems operated exactly as configured. The controls did not.